Okay, let's begin then. So, as I say, welcome to the latest webinar hosted by the MGAA. Today we are joined by supplier members LexisNexis, and the topic for today focuses on extreme weather events and understanding the risk to the MGA market, potentially taking a little bit of a backseat with the current COVID-19 issues in place, but it's always important to hear the latest thinking, thoughts and developments in new and interesting areas. Jonathan, can you just pass to the next slide just to run through the logistics? So just during the webinar, all participants are automatically muted. This is just to prevent background noise so everyone can hear the main presentation and the host. To ask a question, because we're very conscious of this being very interactive, you just need to wiggle your mouse, bring up the chat window, and you can send a question to myself, and we can raise that during the Q&A at the end. For full disclosure, this webinar is being recorded and will be added to the MGAA website, but we will not pass any of your details on to any third parties as per our privacy statement. And finally, and a really important one for us, we do ask and send out that you complete the feedback forms. This is just to get a gauge of what we can do differently, what we can do better and what we can do more of, and just to see what kind of reviews we are getting in terms of our webinars. Jonathan, can you just pass through to the next slide, please? So our speaker today is Jonathan Gard, who has been with LexisNexis Risk Solutions for over 8 years, and he works across commercial markets throughout UK and Ireland, and provides support for LexisNexis products and solutions. Previously, he has worked at Avago, a startup focused on innovative car ride-sharing technology, and has also had roles at Mapflow, Ericsson, and the CSA Group, mainly focusing on sales and business development. And he's also an MBA and worked in some interesting fields such as tin mining, gold exploration, and telecommunications, so particular expert in his field. So without further ado, I'll pass over to Jonathan, who will run through the main body of the presentation.
Thank you, Ben. So thanks for that introduction. So today we're not going to talk about COVID, we're not talking about Brexit, no, we're going to talk about climate change and extreme weather events, and understanding and supporting your customers with understand the risk for their locations and for their properties, and how best to manage that as climate change increases to take a hold on our lives. So what I'm going to talk about this morning is a little bit high level initially about how climate change is impacting the insurance market, and then we'll talk a little bit about the balancing act between general insurance market and the reinsurance market. And the main focus for this presentation is around the data that's available and the technology that helps MGAs and insurers and brokers to be able to assess the level of perils risk at point of quote. We'll have a look at some of those models and some of that data that's being used in particularly the UK market, and where I suppose things are going to go, and how there are technology and data is changing and changing at a pace. So we can all take it that climate change is happening, and this is the polar ice cap back in 1979, and as you can see, it covered the whole of the North Pole. 30 years later, it was down to, basically it lost 20% of the cap, and that's continued to decrease. So that was 2012, and the polar ice cap is continuing to melt. The ice in Greenland and elsewhere is also coming under severe pressure, and this is all because of the temperature warming, which is leading to melting of the ice. And the impact from an insurance perspective is that ultimately the sea level will rise, and with a lot of the world's assets and cities and people living next to coastlines, living near to sea level, this is going to become a bigger and bigger problem as the sea level continues to increase in height. I happened to be in Australia at Christmas time and seeing my son. He's in the University of Sydney. We were there 3 weeks. I don't think we saw the sun. The smoke and smog over Sydney was pretty strong. And I think it was the longest bushfire season and the most deadly bushfire season in Australia. It lasted several into months. And it had a large loss of life and a large loss of property. Not only in Australia, but we've seen similar fires in California. There were fires in Greece there not so long ago. And as temperature rises, ground becomes more of a tinderbox, and it doesn't take much for these fires to catch hold. With the increase in temperature, the oceans are warming, and with the warmer oceans, you get more violent hurricanes and typhoons. There was one only last week in the Philippines, and you also get more the frequency of these events. Last year was we had one of the first in a while anyway, a hurricane in the North Atlantic, which was heading towards UK and Ireland, and we can expect to see more violent storms and more of these events as climate change continues. Closer to home, in the UK, subsidence. So the ABI reported a 350% increase in subsidence claims. How this happens is that in large parts of the southeast of England, there is a clay layer called shrinkswell clay, and the shrinkswell clay shrinks when it's a hot, dry summer after a wet winter. And if you've got trees next to the property, it sucks out the last moisture within the clay horizon, and basically the walls of it, particularly for home, not so much for commercial property, because commercial property tends to have foundations, but where there's no foundations, what you do is you get pressure on the walls, and that causes cracking, and then you have to underpin the property, and there's lots of expensive damage done, and we expect to see more and more of this, and it's not an easy thing to fix. We're not going to get rid of shrinkswell clay, so any properties on shrinkswell clay are at risk from subsidence. Not everyone is a believer. Our friend President Trump, he doesn't seem to believe in global warming and has done his best to try and divert us off doing things of the world acting in unison to combat global warming. This obviously has consequences for insurance down the line, and it's a great opportunity for the insurance industry as a whole to be proactive and be seen to taking on board the data and technology and help customers through understanding risks from climate change. It may seem a long time ago with COVID, but in February it was the wettest month since records in the UK. Every weekend, for a couple of weekends, we had a storm. Storm Ciara, Storm Dennis. This is the Calder Valley. You probably remember Hebden Bridge. But there was a lot of flooding in February, and the water table rose, and there was an overtopping of defences, a lot of property damage, and it sort of brings climate change, I suppose, home in the fact that in the UK and in Ireland we're experiencing such tragic events and the consequences for those who live in these areas or have business in these areas is substantial. I think it's interesting in pictures here you see some cars underwater. These two events, actually, there was quite a lot of motor claims from these events. And actually, the ABI have published stats for both Storm Ciara and Storm Dennis. And as you can see there's about 7,000 vehicles that were either flooded or damaged by windstorm during those events. And that's about 20 33 million in damages. Overall, it was 360 million insured losses from Storm Ciara and Storm Dennis, which these were two significant storms, and if it wasn't for COVID, we'd probably be still talking about them. You know, the whole, I suppose, role of the insurance industry is to understand how these events are going to, where they're going to happen, and the sort of frequency and severity of the damage. So there's not just, people tend to think of these events as affecting maybe residential commercial customers. It's also affecting motor insurance, and some of the claim costs, you can see the average claims cost there for commercial, 56,000. They are significant losses. So what we're going to just talk a little bit about is actually how MGAs and insurers and brokers can identify properties at risk from climate change. What tools, what data are they using to be able to do this? And before we get onto that, I just want to highlight the sort of flow in the market. So if you think the reinsurance market is there to protect the primary insurance market from cat losses. So reinsurers are there, their sole purpose is to make sure that the primary insurance market doesn't go bust every time there is a significant event. And the reinsurers have been using models and data for a long time, and that's their job to understand level of risk, and then they will say, you as a primary insurer, you need this amount of additional cover to protect you from these events. And when you get big events, obviously the reinsurance pool of money is being tapped, and the more events you have, the more the reinsurance money is tapped, and therefore the primary insurers have to pay more money. Primary insurers pass on those costs to the businesses and homes and people that they're taking business from. So it's a sort of vicious circle. So as we get more and more cat events, reinsurance becomes more expensive. They pass on the cost of primary insurer passes on the cost to the customer. So in this flow, we're trying to, I suppose, use data and models to help protect both the primary insurer and their customer base. So what we found is that the data models that reinsurers were using, we brought those models into the primary insurance market, and they're now used at point of quote. So rather than waiting for reinsurance when you do your assessment once a year, we can now assess the level of risk every time a quote is generated. And the upside of that is that it gives the MGAs and primary insurers the opportunity to understand the level of risk and to build that into a price, or maybe build it into a decision that they might not want to take that risk. So that's the sort of how the market has moved. It's moved, the reinsurance processes and technology has sort of moved into the primary insurance market, and now the primary insurance market has the sort of same capabilities that the reinsurance market had. And before models came into the primary insurance market, basically insurers used decline postcodes. So they would have a list of postcodes which say, we don't want any business in these postcodes. Places like Hull would be all the postcodes in Hull would be decline, and it was really hard to get insurance in Hull before the new models and technology arrived. So in about 2005-ish, Norwich Union, now Aviva, they created the first flood model for the UK insurance market, and it was developed by conjunction with JDA, and that model has gone on, and there's now a few other models, Ambiental, and you have NAFRA and other data in the market, but primarily the market had access to a flood model. And what we did was we helped bridge the sort of technology gap between the flood model itself and how an insurer can use it in the process. So a flood model is all sort of, it's scientific-based data set. It's actually a matrix of scores. And what we do is we take that and we convert it into something that is usable, a score basically, that is usable for insurers. So an insurer can type in an address and they will get a flood score, they'll get a storm score, all sorts of different scores, which tells them about that location, and it gives them a sort of an idea of the amount of risk at that location. And about when it was using decline postcodes, you could be on top of a hill and you'd have the same rate value as a property that was flooding at the bottom of the hill. And what this technology does, or the science does, is it basically separates out properties and looks at their elevation, looks at where they are on the model, and it gives a view as to the level of flood risk at that location. And granularity works for flood because we can predict where water flows, where the water will end up, where it will reside. We can predict the depth of flood for different events. And with initially this all started with flood data. There's now a plethora of data out there, everything from building information to data about lots of other hazards, information on, that basically can be used in the insurance process. And so every time you put in an address, you get back a lot of information that helps the MGA or the insurer to understand that location and to be able to provide the right cover, right price for that location. I suppose the other big change in the market is that we're seeing more and more MGAs, insurers looking to write business automatically. So straight through pricing from someone putting in a quote and giving back a price for that location. So the perils models, the flood models, all that data is now available in high volume automated underwriting. So same principles apply. You take the address, you map the address, you get the scores for that address. The scores are then used for pricing, and then that's all done in sub 1 second. So this market last year, for example, I think we did 51 billion transactions in the UK market. Primarily, all of that's pretty much in the motor space. But the principle of being able to take in a quote, find where its location is, gather the information, create the scores, send them back into that underwriting decision process. So the market is definitely shifting more and more to to automated underwriting, and these models and data are now available for use in that environment. Right. So I'm now going to do something that you should never do in a live demo. I'm just going to go over to our live system. So bear with me 2 seconds, because I just want to show what this actually looks like. So if you're an underwriter, this is the sort of tool that you would see. So you basically, this is for sort of manual underwriting. All these little dots here, these are policy counts. This is a test data set. And so you can see this would be your on-cover book. So I can start typing in an address. So I just want to look, I know the postcode. So I start to look up the postcode. And this particular address I'm going to look at is number 33. So the system goes, now that process of going from an address to the point on the map which says A, that's called geocoding. So you take the address, it converts it basically into a coordinate, a lat long, and that lat long can then be mapped. So we now have an address location and number A here. So I can look up the perils information, all the different scores we've been talking about. And in this case, it has an accept. So it's saying that the system's saying that there's no flood risk at that particular location. So you can continue with the underwriting process. And if I go back to that postcode, and if I choose a different address in the postcode, so this time I'm going to choose number 11. So this is B now. So you can see A was where we were looking at, there was no flood risk. And now at B, and if I look up B, I can see it's now got a flood score of 18, which for those of you who know JVA modeling, that's a JVA combined of 18, which will be a high flood risk. So in this case, the system is telling me that it should be referred. And so if I actually look at the map, the flood model itself, so I'm going to turn on the flood model. So you can see darker the blue color, the more extreme the flood. So you can see A is not in the flood area and B is in the flood area. Now both those two addresses are within the same postcode. So if you were using postcodes as a means for underwriting or making a decision, you would basically have A as probably a high risk as well as B. So what this technology does is it allows you to distinguish between locations on a much more granular level. So let me just go back. So as we saw there in that live part, we were looking at flood, and we saw a flood map. This is a subsidence map. This is a particular map of what they call shrink swell clay. I mentioned it earlier in that it causes issues for subsidence, particularly for residential buildings which don't have foundations. As you can see, it covers a lot of the southeast, but we could it's mapped. So this map is from the British Geological Survey, and we convert it into scores, and those scores give an indication of the level of risk. So the principle is you get these peril models. They're built by government agencies, or they're built by specialist modeling companies like JBA and Ambiental, or they're built by reinsurers, or you have companies like RMS and AIR. So there's lots of data being created out there, and then what the technology and tools do is it sort of brings it all in together and then converts it into scores that we can use for rating and underwriting. I talked a little bit there about, we saw in the live demo there where we put in an address and it came back with a location and it indicated whether it was at risk. And that's sort of like, it's gone from being postcode to that centroid, property centroid. We use a database called the address base, which is from the Ordnance Survey. It has every address in the UK, and it has basically an XY for every address. And that will give you the score. As you can see from the red outline here, for commercial buildings, the building centroid may not be the best way of estimating the risk for that location. So we also have the capability of understanding the risk based on a building footprint. So it gives about 400,000 properties which wouldn't be deemed at risk if you use the building centroid, are deemed at risk when you use the building outline. So that's quite a chunk of the property base that you may miss, and it may flood, and you might wonder why you thought you were protected. It's because of the extent of the building compared to the Ordnance Survey's centroid point for that location. Using that sort of same building footprint data set, we can also look at things like fire risk. So I suppose traditionally you would send out surveyors, and surveyors would look at a building, look at the neighboring buildings. It would try to work out, what risks are that I need to add together to work out, do I need to take a package of reinsurance? That's a whole process. It's quite costly. You have to send surveyors out. There's a whole time involved in that. What this solution, what we call blocks, what it does is it actually goes off and it calculates all the policies that I have within the what we call block, which is basically all these building outlines in green that share either a certain distance rule, or it's been decided that they share a common fire risk. So we can provide and say, in A, you've got 5 policies, and this is the total sum insured, and then the insurer can decide whether they need to take out that cover, or whether they don't want any more business within that block, because they've already sort of maxed out in terms of the amount of exposure that they want. And then the blue blocks are what they call secondary blocks. So you might take the maximum, what they call estimated maximum loss, EML, on the green area, and then you might take a proportion of the secondary blocks into account when you're calculating your EML. So this is primarily for commercial reinsurance, and this allows them the underwriter to be able to carry out at their desk what the level of risk is they have at this particular location. And this is really good for insurers who, say, working in London, where they may have capacity constraints, and they're finding it hard to manage their book of business. These tools help you to write more business because it helps to get you a better grip and understanding of the amount of exposure that you have at a given location. So this helps you to write more business in sort of densely urban areas. The fourth area I just want to touch on is how real-time data is now starting to play a role. So there are websites like NOAA, which has storm tracks, so you can go in and you can see storms as they are approaching, and you can get up-to-date information as to where the storm is likely to land, and you can start to model out how much exposure you have. In the UK, the Environment Agency and now JVA are publishing real-time flood data. So what this data does is it gives you the warnings. So let's say the Environment Agency publishes that this river has a severe flood warning. We can take that data and show the amount of policies that you have within that area, and you can either use it to be proactive with those customers, or you might want to use it to plan ahead and decide the amount of sort of people you might need on the ground, or the amount of call center people you might need to have for that particular event. So I think what we're finding is that the data in the sort of flood modeling world, it tend to be annual updates. Well, now we're sort of moving into the real-time world. So the EA flood alerts are every 15 minutes. So technology and data, you know, we're continually improving and advancement in the information and its up-to-dateness. And with drones and with other sensor data, this is only going to become a bigger and bigger thing, where we're starting to get more and more information in much quicker time, and that will be used in the underwriting process. So you'll be able to see now, okay, I've got a high flood alert in this area, I can stop underwriting for the next 48 hours in that location and not take on any business before the storm hits. So we're getting down to that level of granularity and that level of updatedness of the data. So finally, I just wanted to just summarize what we've seen is that the technology has advanced from postcode files that insurers were using through to assessing risk through mapping systems like you saw, through to real-time automated transactional data that's fed into the software houses, the OpenGIs, the SSPs of this world, and the data flows in real time, sub-second, and is being used in the quotation process. The one thing I would say where I see an important role for MGAs is that in that sort of primary insurance, reinsurance world, where the reinsurers are protecting the insurers are protecting their customers, MGAs have that role to play where they can be specialist. They are using the latest technology, they are using the latest expertise, and around climate change, I think there's a real role for MGAs to be, ahead of the game, use this sort of data and technology, use the real-time data, to both protect your customers, but also to protect your capacity provider, in that you're using the best data available in the market, and you can be more, I suppose, speedier and do things a little faster than, say, maybe in the sort of primary insurance market. So I think there's a great opportunity around climate change for MGAs to be seen to be sort of ahead of the curve in terms of using some of this new data and some of this new technology. I have no idea how long that took, so thank you very much. Ben, can I hand you back to you?
Of course, yeah. Thank you, Jonathan. That was really useful and interesting. So now we come to the Q&A section of the presentation. Just as a reminder, if you do have any questions and would like to submit them, please just click on the chat function, and you can type a message through to myself, and I will raise that as and when they come in. We've had a few questions already, Jonathan, so I'll just fire away if that's okay.
Yeah.
What do you see as the next phase of mapping technology that will support the industry?
So I think there's going to be more around sensors. So I think we'll start to see more. So I don't know whether there's an insurer, I think they're called Flood Forecast, or Flood Flash. They basically have sensors which you can put on the outside of your property, and they record water levels, and then they're actually paying out based on the water level. I think you'll see more and more sensors around buildings and around streets that will be measuring flood as it happens, and that data will feed through to these systems. I also think drone technology, understanding where the flood is, how far it's gone, and being able to predict where it's going. So I think there'll be more, as a flood is happening, we'll have more data and more ability to advise customers as to, you know, what's happening on the ground, and whether, you know, they should be warning more customers that the flood is coming their way or whatever. So I think you'll start to see a lot more sensor data. The third area I think there's going to be more information or more protection is that property level protection, PLP. So properties are going to, rather than insurers rebuilding the property as is, I think there'll be more investment made to put a property back with protection. So there's a lot of stuff you can do to your property so that next time it floods, it's not going to have the same level of damage. Putting on doors, putting covers on outlets. So there's a lot you can do to protect your property, and I think you'll see. And I think you'll see more investment from the likes of Flood Re and the Environment Agency and the government around property level protection, because we know climate change is not going to go away. We know that certain areas continue to flood. We know that the defences that are out there are overtopping. So Hebden Bridge is a good example of that, where the defences overtopped, and insurers basically got caught because they have been using, if you've been using, say, JBA scores, you would have thought Hebden Bridge was safe. And then with the overtopping, the actual defences act as dams, and so you get a double whammy. So I think you'll start to see more investment in protecting property from flooding. We also expect to see, for say cities that are at risk from sea level impacts, that there's going to be more investment made to protect cities. So better design of how to get water out of cities, how to protect you know, areas that are next to the sea, and you'll see more science and technology being used to try and make sure that the cities are not going to be and where people live are protected.
Yeah. Okay. Brilliant. Thanks, Jonathan. Another one that's come in. How is the insurance market considering the impact of trees, windstorm, subsidence, etc.? Are these equally as important as flood in pricing risk?
So definitely in the home market. So I'd say because of foundations, subsidence really isn't an issue in the commercial property market, but in the home market, and as I mentioned about the Shrinkswell clay, that certainly has a, you know, if you have a property on Shrinkswell clay, there's a higher risk, and there's a higher risk if you have, so Blue Sky have a trees database, and when you overlay the trees database on top of the Shrinkswell clay, you identify like trees within a certain distance of the property, they are a higher risk than a property that's on Shrinkswell clay without a tree, because the tree will take out further water out of that Shrinkswell clay. Now there's different types of trees that have different, they take out different amounts of water out of the ground. Now unfortunately the models don't tell you what the tree type is, but knowing the canopy size and the height of the tree and the fact that it's next to a residential property on Shrinkswell clay, that's additional information that helps you to sort of be more granular in your assessment of subsidence risk. The other thing is we're developing, in LexisNexis, we're developing a claims database for home, and one of the things that will help in that risk assessment is understanding properties that had subsidence issues and mapping those so that you know, say on this particular street there's been, you know, 4 out of 20 properties have had subsidence issues, and therefore you would use that in your risk modelling. So sort of combination of the BGS subsidence data, the trees data from Blue Sky, and claims data, all of those will help to build a better picture. It's interesting you mentioned windstorm. Windstorm data, Met Office now published a windstorm model for the UK which has gust speeds, and so you can look at areas where they have the highest gust speed, and if you map that with the Blue Sky trees database, there are trees with the high canopies, those being next to properties, And we saw a lot of damage in Storm Ciara and Storm Dennis, where trees fell over on cars and trees fell into properties, that sort of damage. So you can do modeling to predict that, and sort of not just worry about the subsidence issues, but also from the trees data, worry about potential damage to property and cars.
Yeah. Okay, brilliant. Thank you, Jonathan. Another one that's come in. Do you think that insurers may apply endorsements to policies, i.e. if a storm on its way, action must be taken by policyholder to safeguard the property, and that's in respect of kind of real-time alerts?
Yeah, so I know in Australia, for example, where a storm coming in, say on the East Coast, they might know about it 5 days ahead of time, and they actually stop underwriting property during that period. So they know where the storm's coming in, and they'll actually stop physically underwriting in those areas. I'm not sure in the UK yet whether we get to that level, but we can certainly support customers with using that real-time flood alert data as part of the underwriting process. So when an address comes in, we can check to see if it's in a real-time flood alert. If it is in a real-time flood alert, they might make a decision that they don't want to underwrite it, or they want to add some additional price, or they might take flood off the policy, or it might go to sort of specialist providers. With the home market at the moment, obviously you've got the Flood Re scheme. So we provide Flood Re data for customers who are in Flood Re at point of quote. So they also understand the price for that location based on what the Flood Re, what the tax band is for that property, and then the Flood Re level that you would have to, if you were going to submit the property to Flood Re. So there's a lot of information that goes into making assessment on the flood or the price that you want to charge at that location. But I think you'll see more and more where this real-time data will be influencing underwriting decisions, and especially for MGAs who want to be more niche and different to, say, the bigger players in the market, that using this data, they might be a bit more creative and take on some of the risks, knowing everything about the risk. And so you could see where you could provide, say, specialist cover, specialist storm cover, maybe event cover. So let's say you're planning an outdoor wedding and there's a storm coming, then you might not want to price that the same way that you would where you didn't know a storm was coming. I think we'll start to see this real-time data having an impact on underwriting in the UK market.
It's interesting, actually, because as the way that kind of data is used with real-time sort of notifications, data, all that kind of stuff, are there sort of new skills, sort of knowledge that you'd say that underwriters will need in the future in respect of property, insurance, flood, windstorm, etc., what you've just been describing?
Yeah, so I think there'll be, and again, so this falls into the MGA world, in that there'll be more expertise maybe required to differentiate yourselves in this market and using this sort of data. At the moment, the data is used primarily based on a score. So for flood, for example, JBA combined greater than 10 tends to be regarded as a high flood risk within the industry. So there's certain ways the data is consumed and used. But as technology and the data becomes more granular, more real time, I think there will be more sort of differentiation that you can do with the data. So at the moment, I would say it's sort of being used in a pretty standard way within the market. But we would expect with more sensor data, more drone data, and more real-time data, that will change, and there will be more expertise involved in how you set rules and how you use the data. So you'll still have sort of the model scores used in as they are today, but then I think there'll be opportunities to sort of specialize and maybe use the data in cleverer ways.
So do you think that the data that drones can give us, for example, is better quality in terms of using it for pricing?
So I think the drone technology is primarily going to be used for when there is an event. So let's say there's an event going on, there's a mad rush to, where do you put your adjusters, where do you put your resources, how big a call center operation do you need for this event? So I think drone technology will be great for And we also see it with some of the satellite technology that's going on, where you can now direct satellites to map out a flood event. So understanding the scale and size of a flood event is really important to an insurer. I don't think, we also are aware that some insurers are using drones for surveying, so flying the drone over a building to do surveying work on bigger commercial properties. That data is more sort of part of the sort of survey process and not really so much for the underwriting. But I definitely think you will see more mapping of events as they happen, and that will be really important to insurers as they mobilize their claims teams.
Okay, brilliant. Thank you, Jonathan. Another question. So how do you create the peril models? Do you take into account climate change?
So that's a good question. So peril models are created by scientists. So so it's a scientific process. It uses data like weather patterns. So let's say you're making a flood model, you'd be looking at weather patterns, you'd be looking at soil type, elevation data, concrete, how much data is, it basically takes a lot of information, and then it predicts flooding. So it's sort of, it's looking forward. So you basically apply an event to your data, and it will tell you what areas are going to flood and what sort of depth you will get for different severity of events. And these models are created by scientists, and we then take that science model and create it into a score that's useful for the insurance market. So it's quite specialist, and there are lots of companies out there and universities and government agencies who create these models. On the reinsurance side, they have a lot of this science in-house, so you'll find that they will have their own scientists to create models. You have companies like RMS who build global CAT models and are trying to model climate change into those models. And though that sort of technology and process is filtering down into the model process that's being used within the primary insurance market. So it's not something that insurers will tend to do themselves. It tends to be done by specialist scientists who have the data and the computing power. I just noticed that I think it's the Met Office in the UK are planning to spend £1 billion on their new computer for climate change, and to be able to model down to, I think it's 500 meter squares, weather patterns. So the huge investment goes into these models and into the data, and insurers are benefiting from all that investment that's being made.
And is claims data used within those models? So
that's a thing that LexisNexis is working on, is that we've seen, if you look at the recent storm Kira event, for example, the flood models didn't predict High Street of Tewkesbury to be flooded, but if you look at the historical data, that High Street flooded in the past, and when the flood defences got overtopped, the water went to where it flooded previously. So sometimes looking at historical claims has additional value on top of the models. So the models have a certain role to play in predicting, but the claims data also has further protection in that you knew that this area has flooded in the past. So the EA publishes a map, we call it EA Historical, and that's very useful for telling you how many times that property has flooded in the past. So and that data goes back a long time, so you can see that this area has flooded 5 to 6 times, and so there's a history of flooding here, and so you can take that into account as well as the predictive models. So yeah, so claims data definitely adds an extra layer of information for working out that risk.
Great, thank you very much, Jonathan. We've run through all the questions that have come in, so we'll look to end the webinar there. Thank you very much to Jonathan and LexisNexis for hosting that. That was really insightful, and thank you to answering all the questions that are bombarded to you. For people still listening, our next webinar is next week, and that's from Gallagher Bassett, and that's looking at how COVID-19 has impacted the claims handling operations. If you're interested in that, please register on the MGA website. But thank you very much for dialing in, and once again, thank you, Jonathan, for hosting.
Thank you.
Thank you very much. I'll end the webinar there.